Hello friends, welcome to my channel Learning with Z. This is the fourth video in the series of Introduction to Macroeconomics. The topic for today is Methods of Calculating National Income. If you are new to my channel, then please don't forget to subscribe it and press the bell icon to receive the latest updates. Let's move on to see what are the different methods of calculating national income with examples. There are three methods of calculating national income: value-added method, income method, and expenditure method. Let us now look at each method in detail. Let us look at the value-added method first. Value-added method measures national income in terms of value addition by each producing enterprise in the economy in an accounting period. As we have already studied in the final goods and intermediate goods classification, that value keeps adding to the intermediate goods until they have reached the final goods stage and no more processing remains to be done. So, in this method of estimation of national income, value is added up to reach at the GDP at market price. It is also known as net output method because it takes into account net output, that is final goods, which encompasses all the value addition that has happened over the production period. So the formula here will be gross value added, or GDP at market price, equal to value of output minus intermediate consumption. Here the value of output will be equal to sales plus change in stock. Please note that in case the company is able to sell its entire production during that year, the entire value of output will be equal to sales. But in case the company is not able to sell its entire production, then there will be some stock remaining at the end of the year, which is called the closing stock. So the change of stock may be calculated by subtracting opening stock from the closing stock and adding it to the sales. So the formula will be value of output equal to sale plus change in stock. To this value of output, we will deduct intermediate consumption, which is value of raw materials used in the production process. This gives us gross value added, or GDP at market price. To this GDP at market price, we will deduct depreciation, net indirect taxes, and we will add net factor income from abroad to arrive at net national product at factor cost, or national income. Let us look at the important points to remember for value added method. First, value of intermediate goods not included. Like raw material, as we have already mentioned, we have to deduct it from the value of output. Value of sale and purchase of second-hand goods is not included, as they are already accounted for in the year of production when they were first produced. Third, commission on sale and purchase of second-hand goods is included because they are earned in lieu of rendering a service. Own account consumption of goods is included. Whether the production is for sale or own account consumption, it becomes part of production. Similarly, production for self-consumption is also included. Value of rent of self-occupied house is included. So whether the house is rented or is self-occupied, value is included in the production. Service for self-consumption is not included. So only paid services becomes part of production. Unpaid services or service for self-consumption does not become part. Let's take an example. Look at the data provided for a company. You are given sales, raw material consumption, closing stock, opening stock, depreciation, net indirect taxes, and net factor income from abroad. The formula for calculating gross value added, or GDP at market price, is value of output minus intermediate consumption. Here, the value of output will be calculated as sales plus change in stock. we are given sales figure and change in stock, which is closing stock minus opening stock. So 6,800 plus 1000 minus 200, that is 800, will add up for the gross value added, and to this we will deduct 5,000 consumption of raw material, that is intermediate consumption, to arrive at the GDP at market price of rupees 2,600 crore. To this, we are going to make adjustments for depreciation, net indirect taxes, and net factor income from abroad to arrive at the national income. So, to the GDP of 2,600, we are going to deduct depreciation of 200, net indirect taxes of 350, and add net factor income from abroad of 50 to get the national income of rupees 2100 crores. Let us look at the second method of calculating national income. This is called income method. Income method measures national income in terms of factor payments during an accounting year. Here, the factor income can be classified into three subparts. First one is compensation of employees, which further includes wages, salaries, payment in kind, PF contributions, pension on retirement, etc. Second is operating surplus, which includes rent, interest, profit. Here, the profit can be further divided into dividend, corporate profit tax, and retained earnings. Retained earnings are also known as reserves or surplus of the company. The third component is mixed income, which is referred to as income of the self-employed. It is the combination of the above two factor incomes. So in this method, we arrive at net domestic product at factor cost by adding up compensation of employees, operating surplus, and mixed income. And to this net domestic product at factor cost, we will add net factor income from abroad to arrive at national income or NNP at factor cost. Important points to remember for income method. Transfer earnings will not be included since they are not earned in lieu of a service. Income from illegal activities will not be included. Commission on sale and purchase of second-hand goods will be included. Brokerage on sale and purchase of bonds will be included. This is because a service has been given and for it, it is earned as a reward. Windfall gains like lotteries will not be included because there is no service render here. Value of rent of self-occupied house will be included. Income tax paid out of compensation of employees will not be included. This is because income tax is paid out of the compensation component only, and we already factor in the compensation component while calculating the factor income. So again adding the income tax would lead to double counting, which we won't do. Let's look at the example. Here you are given compensation of employees, rent, interest, profit, and net factor income from abroad. We will first calculate the net domestic product at factor cost by adding up compensation of employees, operating surplus, and mixed income. Since the question doesn't give any mixed income component, so we are just going to add up the operating surplus and the compensation of employees, which is 2000 plus 400 plus 500 plus 200, and we get the total of NDP at factor cost at rupees 3100 crore. To this, we are going to add the net factor income from abroad of rupees 50 crore, and we will get the national income as rupees 3150 crore. The third method of calculating national income is expenditure method. In this method, expenditure on purchase of final goods and services produced in the economy during an accounting year is measured. The expenditure can be of two types. It could be final consumption expenditure, which can further be private final consumption expenditure or government final consumption expenditure. And it can be the second type, final investment expenditure. Final investment expenditure can again be of two types, gross domestic fixed asset expenditure or inventory expenditure. Here, the gross domestic fixed asset expenditure can either be done by business or government or a household. And inventory expenditure will be calculated as change in stock, that is closing stock minus opening stock. In expenditure method, we add another component that is called net exports. Since exports is done for goods that are produced domestically, so the expenses done by the foreigners on the purchase of domestic products becomes the part of GDP at market price. Similarly, we deduct the expenses incurred on imports of foreign goods since it is an outflow. Hence, the net exports become the part of expenditure method. So, if we look at the formula, the formula for GDP at market price will be final consumption expenditure of both private and government, gross domestic fixed capital formation, inventory expenditure, and net exports. To this, we will adjust for depreciation, net indirect taxes, and net factor income from abroad to arrive at national income. Let us look at the important points to remember for expenditure method. Expenditure on intermediate goods is not included. Expenditure on second-hand goods is not included. Expenditure on shares and bonds are not included. Transfer payments are not included. And expenditure on goods of self-consumption is included. Let's take an example here. Suppose we have been given this data for a company. In order to arrive at the GDP at market price, we will add private final consumption expenditure of 1200, government final consumption expenditure of 2600. To this, we are going to add gross domestic fixed capital formation of 500, inventory expenditure of 250, and the net exports, which is negative here in this case. So we will add the negative 100, which is minus 100. And we will get the GDP at market price of rupees 4,450 crores. To this, we will adjust depreciation of 100, net indirect taxes of 200, and net factor income from abroad of negative 50 to arrive at the national income. So friends, thank you for watching this video. Hope you have found it useful. If you want to watch more such useful videos that are simple to understand and easy to remember, please like, share, and subscribe it. Also press the bell icon for getting the latest updates. Thanks.